Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing QuantumScape stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. QuantumScape does research about solid-state lithium metal batteries for electric cars. The other type of battery, a lithium-ion battery, is used in smartphones, power tools, and EVs. It uses a liquid electrolyte solution. A solid-state battery uses a solid electrolyte, not liquid. The problem with lithium-ion batteries is there's a risk of damage, such as swelling caused by temperature changes, or leakage caused by external force, since it uses a liquid electrolyte solution. Solid-state lithium batteries are far superior, but no one can figure out how to mass produce them. This company is backed by Bill Gates and Volkswagen. In 2012, it began working with Volkswagen. In 2018, Volkswagen invested $100 million in this company, becoming the largest shareholder. In the same year, Volkswagen and QuantumScape announced a project to prepare for mass production of solid-state batteries. In June of last year, Volkswagen made an additional $200 million investment into this company. The company's partnership with VW will help them a lot, since VW made almost 9 million cars in 2020. Also, VW plans to invest $41 billion in electric mobility by 2025, with plans to make 70 EVs. Last week, Quantum partnered with another big car manufacturer. Quantum has not announced which company they're working with. The big car manufacturer that this company's working with, that's not Volkswagen, they've done evaluation on the company's solid-state batteries, and they plan to buy them in the future. The batteries may be available in 2023. That's when QS plans to begin manufacturing. QuantumScape was funded by a SPAC. A special purpose acquisition company is formed to raise money through an IPO, then acquire a private business to help them go public. At the time of their IPOs, SPACs have no existing business operations or even a company they plan to acquire. SPACs have 2 years to complete an acquisition, or they must return the funds back to investors. On September 3rd of last year, QuantumScape announced a merger with SPAC Kensington Capital. As a result of the merger, QuantumScape received $1 billion in financing, including funding from Volkswagen and the Qatar Investment Authority. The transaction was completed in November 2020. On April 15th of this year, hedge fund Scorpion Capital announced their short position in QS, accusing the company of being a pump and dump scheme. Scorpion claims that no one can figure out how to avoid dendrites from ruining batteries, even though QS claims it is the first company to figure out how to avoid this problem. Dendrites are metallic growths that short the battery and cause it to fail. This issue has been known for over 50 years, and no one can solve it. The company is headquartered in San Jose, California, was founded in 2010. It started trading in 2020 and can be found in the New York Stock Exchange and Mexican Bolsa. Let's get started with the model. This is a mid-cap company, 9.5 billion market cap. They're trading at $23 a share, and they have 416 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video, and free cash flow is cash flow from operations minus capital expenditures. So of course they have negative free cash flow each year since they're pre-revenue. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's also negative each year. This is the company's income statement. The top line is the revenue, the sales, which of course is zero each year. Below that is their operating expenses. Here's a breakdown of their operating expenses. Last year they spent $46 million in R&D. This year it's $65 million. So this company is going to spend a lot of money on R&D every single year. Research and development is the payroll they pay to the employees for conducting the research. If the company bought an expensive machine, say for $1 million, the depreciation of that machine would go into R&D. General and administrative expenses, this is mainly payroll because there's some employees working on the operations of the business, like the administrative assistant, maybe an accountant or someone in legal, and possibly the people in management as well. So their salaries go into general and administrative expenses. Also, stock-based compensation goes into general and administrative. Lots of companies subsidize employee salary with stock. And they do have a little bit of debt, so they paid $21 million of interest on their debt in the trailing 12 months. And they reported over $1 billion of losses. That seems really high because their operating loss was only $81 million. The company had to restate their 2020 financials because they reported warrants as equity. They needed to report that as debt. Warrants are long-dated options. A regular option usually expires within 2 years. Warrants can go more than 2 years. They can go 3, 5, 10, or 20 years. So warrants are just long-dated options that are sold by the company to investors. This is a non-cash item. The value of the warrant is being passed through onto the income statement as a loss. When the warrant is exercised or expires, then they'll pass through a gain onto the income statement. But this can be really confusing because it looks like the company's doing really bad, losing over $1 billion. But that's not the case. It's pretty much due to the mark-to-market of this warrant. You'll see on the statement of cash flows. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company lost from its operational business. So you can see they only lost $61 million of cash. So look at the statement of cash flows. That's usually a better indicator of how a company's doing than the income statement. They also spend a good amount in CapEx, $58 million in the trailing 12 months, because they need to start manufacturing this product at some point. Operating cash flow minus CapEx gives you your free cash flow, and they're mainly funding their business on stock. They received over $1 billion. Most of that money came when they IPO'd. This is the equity section of their balance sheet. They have $1.5 billion of equity, and they generated $3.5 billion from selling their business, and they lost nearly $2 billion from running their business. Retained earnings is a sum of all your prior net incomes, but we know most of these losses were due to the warrants. When the warrants are exercised, these losses will reverse, so their retained earnings will improve a lot. So maybe 3, 4, 5 years down the road, you're going to see a big gain on the income statement from these warrants. And at that time, hopefully you'll remember this video. Let's look at the capital structure. $1.5 billion of equity, $63 million of debt. They're 96% equity, 4% debt. Their net debt is negative $1.5 billion. Net debt is total debt minus the cash on your balance sheet. So they have a ton of cash on their balance sheet. Their weighted average cost of capital, which is a blend of the cost of equity and cost of debt, is 10.11%. And that's a discount rate we're going to apply to the future cash flows. We estimated 5 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 5, that's $15 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $9.5 billion. We divide that by 416 million shares. And we get a calculated stock price of $22.89. So I didn't really value this company because there's not that much information to value them. And I think it would be total guess if I tried to. So I just showed you what their free cash flows would need to be to justify their stock price. So I think they'll have negative free cash flow for a while. And if they could generate $1.1 billion in 2025, then that indicates the stock is trading appropriately. The average company converts 10% of their revenue to free cash flow. So this implies they would need $11 billion of revenue by 2025. If you believe they can hit $11 billion of revenue by 2025, then maybe you should buy the stock. The company said they anticipate $39 million of revenue by 2025, a lot lower than $11 billion. But it does target $3.2 billion by 2027. If their batteries are as successful as they portray they are, then they can hit $100 billion of revenue by 2025. But as you know, things don't always go as planned. We just need to see how things develop. 3 analysts priced this stock and the average price target was $34. So it seems like analysts are saying this stock is undervalued. So you can see back in December, the stock was trading at over $130. You can see the wick got up to over $130 on this candle. But a lot of people sold off thinking the stock was way overvalued. Now it's come down to reality. The company's valuation was higher than Ford Motor Company. Ford, a company that's been around over 100 years, that makes so many cars, it sells more trucks than any company in the world. And at one point, it was worth less than a company that never sold anything. The stock is up 64% in the past 52 weeks, much better than S&P 500. The low was 11, the high was 133. And the stock is trading slightly above its 50-day, but well below its 200-day moving average. And this is a really popular stock. Over 10 million shares are traded each day. Of the 416 million shares outstanding, 239 million are on float. 29% are held by institutions, and over 16% of the shares on float are shorted. So it has a really high short percentage. Analysts are bullish on this stock, projecting their earnings to grow 44%, their revenue to grow 89%. Even if their revenue grew 1,000,000%, it would still be zero. I think they mean once the company starts bringing in revenue, it should grow 89% a year after that. A bullish sign is when a company is adding employees, because if they're paying people to work there, that does indicate there's some demand for their products. They had 219 employees last year, now they're up to 400. If you put $10,000 into the stock when it was trading as a SPAC, you'd be really upset because you'd be at $25,000 today. Why would you be upset? Because you would have been well over $100,000 in the beginning of the year. Let's look at their financial ratios. We can't look at the PE since they have negative net income. We can't look at the price to sales since they have no sales. They do have a good price to book ratio. That's only because they raised so much cash from their IPO. They have a really high current ratio and quick ratio because they have almost $1.6 billion of cash on their balance sheet. So this company is really well funded. They have a lot of money to work with for the next few years or to acquire other companies. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 9 companies in the same industry as QS. And if QS has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they have really bad ratios since they're pre-revenue. They have a really high current ratio and they're low in debt. And their market cap is pretty high for a company that hasn't had any revenue yet, $9.5 billion. Their market cap was 6 times this, close to $55 billion, which is just crazy for a company that never sold anything. So to summarize, it sounds like this company has the next big thing that's going to change the world. But we hear this a lot from a lot of companies. It is promising they have all these relationships with Bill Gates, Volkswagen. But when you develop a product, even if you can get that product to work, that's just one step. Another step is making millions and millions of that product that works just as well. That's a lot different. Sometimes mass producing things can be really, really tricky because when you mass produce, there's a little less oversight. So it's possible something can go wrong during the process. It could be the result of a human error or possibly a computer error. If you made watches and you mass produce watches and say out of every 10,000 watches, 1 doesn't work well, it's not the end of the world. It's annoying for that one person, but they just return the watch and get a new one. But in this company's case, if one of the products is bad out of every 10,000, it could kill somebody. There's not much room for error. You have to have no mistakes, which is really hard to do. That's why no one has been able to mass produce what this company is trying to do. So at this point, the only thing we can do is wait and see how things turn out. And if you want to risk your money, it's not a terrible investment, but of course, any company that's pre-revenue is a much bigger risk than a company that has a longer history with profits and revenue. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.